and will send out notices. This part is aimed more at the smaller businesses, things that they will need to know to be preparing for Affordable Care Act compliance in 2016. The December program will be aimed more at everybody. The first topic we're going to discuss today is how to determine who must comply with the employer mandate and when. Starting in 2016, and we'll get to the effective date for different employers in a minute, but starting in 2016, employers with 50 or more full-time employees and full-time equivalent employees will be required to be subject to the employer mandate. It's a pay-or-play mandate, and it's not a crime to decide you're going to pay instead of play. It's like okay to incur the penalties, although there are some incentives not to, particularly the fact that the penalties are not deductible. But we'll get to in a few minutes how to compute the penalties. But for now, let's look at how one determines whether a particular employer has 50 or more full-time employees plus full-time equivalents. You look at all of the controlled group and affiliated service group members. So if there are multiple entities within the group, you have to count the employees of all of them. If there is an affiliated service group, you count the employees of all of them. What you're trying to determine is whether the particular employer is an applicable large employer. That's the term used in the regulations to determine who is subject to the mandate. If you're an applicable large employer, or ALE, then you will be subject to the mandate. Now, the status, whether a particular employer is an ALE is determined based on the prior calendar year. So for 2016, it'll be determined based on your data in 2015. And once it's determined, then that status is fixed for the entire calendar year. So if in 2015 you averaged 50 or more full-time employees for all the months, full-time employees plus full-time equivalents for all the months in the year, then you will be an applicable large employer for the entire 2016. There is a special rule regarding the computation for employers who hire seasonal employees. They get to be treated a little bit differently. They get to be ignored if an employer who uses seasonal employees who qualify will not become an ALE solely because of the seasonal employees, and there are some complicated rules for that, and we won't get into the details of that in this particular program. But other than the seasonal employees, you count everybody who is an employee of the employer. If there are control group members or affiliated service group members, the regulations call each entity within the group an applicable large employer member. And some of the tests as we go along will be applied to each member, but the overall test as to whether anybody in the control group has to comply, whether anybody is part of an ALE, is determined based on the entire control group and the entire affiliated service group, and it takes into account everybody who is a common law employee except for the special rule for some seasonal employees. Now, how do we do the count? ALA status is determined by adding the actual full-time employees, those who are expected to work 30 or more hours per week. Each of those individuals who qualifies as a full-time employee is treated is counted as one person. But then you have to add to that the full-time equivalents. Now, you're looking, well, in a minute we'll talk about the exact calculation, but first you have to determine who all the individuals are that you're going to be taking into account. So for this test, you're looking first at every employee of the control group, the affiliated service group, everybody who meets the common law standard. And incidentally, be careful. A lot of employee leasing requirements, we don't know if the IRS is going to recognize those as not being common law employees. It'll depend on the facts and circumstances as to who really is the employer. The Department of Labor has talked about having an economic reality test, so that a lot of people who have traditionally gotten away with being treated as independent contractors or as leased employees may be subject to review, because the calculation for the Affordable Care Act is so precise, and it's so important to know who all your employees are. But to determine whether you're subject to the mandate, you look at who all your common law standard, who all meets the common law standard for employees of any member of the group. And you want to take a careful look to make sure that nobody has been misclassified, because you could, I mean, if you think you have 45 and there are 5 full-time independent contractors that you think are really independent contractors and they turn out not to be independent contractors, then you're at 50. Okay, you're going to calculate the full-time equivalents. To calculate the full-time equivalents, you will take the people who are not full-time employees, and you will total all the hours that they have, but not more than 120 hours for a person. Then you will divide that total number of hours by 120 to get the number of full-time equivalents. Then you will add that number to your actual number of full-time employees to determine whether that number is over or under the 50 employee threshold. The calculation details that I just specified are not on this slide, but I just added them to a slide that will be on the website. And all of this will be on the website after the program, and you're free to access it. Now, okay, suppose that you meet the 50 employee test or more. Suppose you have 100 or more employees. What's the effective date for when you have to worry about the employer mandate? The effective date generally was January 1st, 2015, and originally that was going to apply to everybody with 50 or more full-time employees and full-time equivalents. However, the administration gave those between 50 and 100 an extra year to get ready. So January 1st, 2016 will be the effective date for employers who are between the 50 and 100 individual threshold. Again, both the 50 and the 100 employee threshold are full-time employees plus full-time equivalents. Now, if you have a non-calendar year, you may delay compliance until the first day of the plan year that begins after January 1st, 2015. If you're over 100, and January 1st, 2016, if you're between 50 and 100. So you do generally have the right to delay the start until the beginning of your plan year. There are some conditions for that, and one of them is that you can't have changed your plan year in the last few years in order to in order to try to game the system. But if you've got, say, a plan year that ends April 30th, and it's always ended April 30th, starts May 1st, then your effective date for the mandate will be May 1st, 2016 if you're between 50 and 100. If you are 100 or more, you've been effective for several months. All employers should carefully examine their non-calendar plans to determine whether they can delay compliance, and in situations where they want to, there are a number of conditions. The conditions aren't listed on the outline, but those conditions need to be checked to make sure the employer is entitled to delay the effective date. As I've indicated, employers with at least 50 but no more than 99 full-time employees, including the full-time equivalents in 2014, were allowed to delay compliance until 2016, subject to the conditions for that deferral. One of the rules for the transition relief is that you can't have changed your workforce significantly in order to get below 50. You can have had, I mean, say you had 150 employees with 3 business units, and you sold 2 of the business units. If it was a bona fide sale, that's okay, and you only have to deal with the business units that are left. But if you made changes that were an attempt to game the system, then you may not be entitled to the transitional relief. Or if you changed your plan year at the last minute, then you might not be entitled to the transition relief. And in that case, if you don't qualify for the transition relief, then you're subject to all of the rules now. But assuming you meet the requirements for the transition relief, then January 1st, 2016, or the first day of your plan year that starts after that date will be the time when you need to comply or worry about the employer mandate. Now, what does the mandate involve? Basically, as I said before, it's a pay or play system. You either provide coverage to your full-time employees or you pay a penalty. Some penalties that you pay are put in the code to reflect the fact that incurring them means you're guilty of bad behavior. This penalty is not in that category. It's perfectly permissible to decide you're going to have the penalty instead of go to the trouble of actually providing coverage to the employees. That's kind of an expensive option because the penalties aren't deductible. So there's a real incentive for you to provide the coverage instead of paying the penalty. But you won't go to jail for deciding that you're going to pay the penalty instead of provide the coverage. It's permissible. You're not violating any laws if you fail to provide the coverage. You're subjecting yourself to a penalty, but it's not in the same category with other rules that you might violate. It's okay to decide you want to pay the penalty, but it can be a significant penalty. There are 2 tiers of penalties. The first tier, the penalty may apply if the employer does not offer coverage to substantially all full-time employees. And then there's another penalty for those who do offer coverage to substantially all full-time employees, but some full-time employees still go through the cracks and end up getting coverage from the exchange. The trigger for a penalty is that an employee gets coverage through the exchange and qualifies for a subsidy in order to do that. The A penalty is the first penalty. It's sometimes referred to as the A penalty because there's an A in the code section. This penalty that is imposed if you fail to offer coverage to substantially all full-time employees. Well, what is substantially all? Substantially all is 95%. Starting in 2016, substantially all is 95%. It was 70% for 2015 as part of the transition relief, but starting in 2016, it'll be 95%. And to avoid the A penalty, you'll want to make sure that you offer coverage to at least 95% of your employees. The coverage that you have to provide has to have minimum value, and a plan provides minimum value if it covers at least 60% of the total allowed cost of benefits that are expected to be incurred under the plan. This is equivalent to what they would call a bronze plan on the exchange, and there are methods to determine minimum value that are on both HHS and IRS websites, and so that can usually be determined by consultants and the brokers who help sell the coverage. There is a special rule that minimum value must include substantial hospital and physician coverage. Some people had figured out ways to design plans that actually did meet the bronze level test, but either didn't include any hospital coverage or didn't include any physician coverage, and that's now not allowed. The government has stated that you have to include those basic things in order for it to have minimum value. And also it has to be affordable. And coverage is not affordable if it costs an employee more than 9.5% of household income, but the employer doesn't usually know that, so there are some safe harbors to determine that. We'll come back to minimum value and the employer mandate. But let's talk for a minute about the penalties to make sure you know what's at stake. The A penalty is $2,000 per full-time employee minus the first 30. Now, that penalty, at first glance, it seems like the A penalty of $2,000 per full-time employee might be better than the $3,000 per full-time employee B penalty. Well, that's not correct. The $2,000 full-time employee is multiplied by all of the employer's full-time employees minus the first 30. So and the A penalty is triggered if even one full-time employee qualifies for coverage through the exchange and qualifies for a subsidy. So the stakes for the for the A penalty are very high. $2,000. Say you have 50 employees. Even though you get the first 30 free, $2,000 times the remaining 20 is still going to be an uncomfortable number for many employers, and it's triggered not by the number of people who qualify for subsidies under the exchange. It's triggered by one employee qualifying for subsidies under the exchange. So if you don't offer 95% of your employees affordable minimum value coverage, then the A penalty would be $2,000 times the number of full-time employees minus the first 30. Now, suppose you do offer minimum value affordable coverage to 95% or more of your employees. There's still 5% of the people who aren't getting coverage. I mean, you're free to offer it to 100%, and in fact, that's generally recommended in order to reduce the risk of getting any penalties. You're going to want to offer coverage to 100% of your full-time employees. But suppose there are some that you decide not to cover because 95% isn't 100%, and you can avoid the A penalty by leaving out some employment categories, or maybe there's an independent contractor that you didn't realize was an employee, and the IRS comes in and recharacterizes, and that person ends up qualifying for a subsidy under the exchange. If you've offered 95% or more of your full-time employees coverage, then you won't have to pay the A penalty, but you'll still have to pay the B penalty on those individuals. And that penalty will be $3,000 times the number of individuals who receive the premium tax credit through the exchange. So the big penalty can be avoided by offering 95% of the employees coverage, but anybody who isn't offered coverage is at risk for the B penalty, and there's no minus the first 30 on the B penalty. There is an override. There is a special rule that says that an employer won't ever have a B penalty that costs more than the employer would have paid if the employer hadn't offered coverage to anybody. So the minus the first 30 rule is applied in calculating the override. So, I mean, it would be really bad if something went wrong, which might happen, say, if the coverage isn't quite minimum value or something like that. If the employer ended up with the B penalty and ended up with $3,000 times all of its full-time employees minus the first 30, that would be, that would be really bad, and it'd be a penalty for trying to offer coverage but not doing it right. And that won't happen because there's a cap on the total penalty based on what would be the A penalty if you hadn't offered coverage at all. But generally, for the people that slip through the cracks and qualify for a subsidy, even though most of your employees are getting coverage, for those individuals, there will be no minus the first 30. It'll be $3,000, excuse me, times the number of people who qualify for the subsidy. Now, let's go back and talk a little bit more about what it takes to avoid the penalties. In order for the coverage to count, in order for offering coverage to substantially all, i.e. 95% of the employees, it has to have at least minimum value. And as I said before, that's equivalent to the bronze level. It has to be designed to cover 60% of the total allowable cost of benefits that would be expected to be incurred. Basically, that's approximately equivalent to what we call a high deductible plan today. An employer who wants employees to qualify for an HSA and wants a high deductible plan, that would typically be a bronze level plan. The silver level plan would be a more normal plan that would cover like 80%, or no, that would be a gold level plan that would cover 80%, 70% would be the silver level. And the consultant should be able to get information from the HHS and IRS websites to determine what your minimum value is. As I indicated before, some people got clever and decided to beef up benefits other than hospital coverage or other than physician coverage or both, and to be able to reach the 60% threshold without covering the things that most employees are likely to need. And the agencies have put a stop to that, and it will be necessary for any coverage that wants to meet minimum value to cover substantial hospital visits and substantial physician charges. Affordable coverage. Let's talk more about affordable coverage. For the individual who shows up at the exchange and wants the subsidy, the employee does not qualify for the subsidy if the employee has been offered affordable coverage by the employer. So the employee applying for a subsidy on the exchange has to answer the question, does your employer offer you affordable coverage? When the employee is dealing directly with the exchange, that affordability number is 9.5% of the employee's annual household income. Well, for the employer to be planning to offer coverage, the employer isn't going to know what the employee's household income is. So there has to be a way for the employer to make plans, short of requiring family tax returns of all the employees. That would be unworkable. So there are 3 safe harbors that the IRS has put into these regs to allow an employer certainty. And excuse me, if the employer has complied with any one of these safe harbors, then the employer will not have a penalty for that employee, even if the employee does turn out to qualify for a subsidy based on the employee's actual family wages. One of the safe harbors, and the one that I think most employers are probably using, is the W-2 safe harbor. If the employee's premium that the employer wants the employee to pay for the coverage is not more than 9.5% of the employee's W-2 wages that the employer pays, then the employer, that meets the affordability test for the employer. And if the employer offers 95% or more of its employees minimum value coverage that they don't charge any more than 9.5% of W-2 wages from that employer, then that employer will be fine and will not be assessed the A penalty. Again, the ones who aren't offered coverage could still trigger the B penalty, but we'll get to that. So the W-2 wages safe harbor is probably the easiest one for an employer to use. And you could do it one of 2 ways. You could do it by setting a dollar number that you know is no higher than 9.5% of any employee's W-2 wages. Or you could cap each employee's premium that you charge at that employee's W-2 wages. Some employers don't really know their W-2 wages as they go along. Tipped employees are an example. And if the employer is relying on the W-2 safe harbor, it's not easy to adjust health insurance retroactively. You kind of have to, an individual has to know from day to day whether he or she has health insurance. When you get sick, the idea of, well, I don't have it right now, but I could get it reinstated retroactively, that doesn't work for health insurance like it does for pension plans. So some employers won't be able to predict what the W-2 wages are going to be, and that may make the W-2 safe harbor hard to use. There is a rate of pay safe harbor, and that would be taking the rate of solid pay, excluding bonuses and overtime and excluding tips. And if the employee premium is no higher than 9.5% of the employee's rate of pay, that would be permissible. Now, that's not as desirable from the employer's standpoint because there's a part of the employee's compensation that the employer could ask for 9.5% of that too that's not being captured by that rate of pay safe harbor. but it is a way for the employer to move forward, and many employers don't charge their employees as much as 9.5% of their wages anyway. Many employers heavily subsidize their employee premiums, and so for many employers a rate of pay safe harbor will be fine. A third safe harbor is the federal poverty line. You can find out what the federal poverty line for your area is, and whatever that is, if the premium you charge any employee is no more than 9.5% of that federal poverty line, then the employer has met the safe harbor too. Again, that's usually going to be a lower number than either the rate of pay safe harbor or the W-2 safe harbor, but it is a safe line that the employer can draw, and that safe harbor works even for employees who happen to earn below the federal poverty line. So the federal poverty line is independent of what the employee's actual rate of pay is, and it is a safe harbor that the individual can use. Now, you only have to look at the employee's own pay to determine affordability. The coverage that has to be offered has to include the children, but the employer isn't required to subsidize the children. The employee can be forced to pay 100% of the coverage costs of covering the children. Most employers don't do that, but you won't be violating the mandate rules if you make the employee pay the freight for the children. You're not required to cover the spouse at all, but most employers do, and you can make if you cover the spouse, you can make the spouse pay the full freight. There are gaps. You can kind of see that there are kind of workability gaps in this situation, and there, you know, the safe harbors for the employers have been worked out to be manageable for the employer. The statute just doesn't incorporate costs for the family members in it, and there are going to be lots of people who in fact, there's some people who end up not qualifying for subsidies for themselves or their families because the employers meet the safe harbors, and that's kind of a problem that is going to need to be worked out over time. And so there are some situations where there are individual inequities in the system. Okay. We've talked about the A penalty and the B penalty. The assessment of the penalties. You can imagine that if there's this set of rules run by the IRS with a penalty tax, there's probably going to be reporting, and there is, and we'll talk about it in a little more detail later. There are reporting requirements. You're going to have to notify the IRS as to who does and who does not have coverage, and you're going to have to report to the individuals as to whether they have coverage and what category of coverage they have. Now, we're used to having taxes, including penalty taxes, have to be self-assessed. You know, if you fail to offer COBRA to somebody you're supposed to, then technically you're supposed to file a form and declare the COBRA penalty tax. If you, a lot of other kinds of taxes that are incurred in the employee benefits arena and otherwise, you're expected to self-assess them and to pay them. This tax, the A penalty and the B penalty, don't work that way at all. In fact, the IRS does not want you to self-assess these penalty taxes. Basically, you do the reporting. You're going to tell the IRS who does and does not have coverage, and you're going to tell the individuals whether they have coverage and what kind of coverage they have, and the IRS will get similar information from the individuals when they sign up for the coverage, and the IRS will sort it all out. The IRS will determine whether a given individual is entitled to a subsidy based on the information that individual provides, and then the IRS will contact the employer if there is an individual that the IRS is providing a subsidy to, and will find out whether the employer owes the penalty by getting the employer's response to its notification. There could be many reasons. I mean, the IRS may reach out to employers who legitimately don't owe any penalty. For example, the individual may not be your employee anymore, and or the individual may have qualified based on actual family income, and that maybe showed the coverage was not affordable for that individual between the employee and the exchange, but the employer may have qualified for an exemption from the penalty by meeting one of the affordability safe harbors. So just getting notified by the IRS doesn't mean you owe the penalty. It just means you have to explain to the employer why you don't owe the penalty, but if you have a satisfactory explanation, then there will be no penalty due. Now the coverage must be, okay, coverage is only offered to actual full-time employees. The full-time equivalents that you had to compute to determine whether you were subject to the mandate or not, once you determine if you're subject to the mandate for a given year, then you don't need to use that full-time equivalent number at all for that year. You'll have to use it for the next year, but the only purpose for determining your full-time equivalence is to figure out whether you're subject to the mandate. And if you are, then the only people you offer coverage to are full-time employees. If you have a lot of part-time employees, it's possible that you could have fewer than 30 actual employees. I mean, you could have like 150 full-time equivalents based on lots and lots of part-time employees, and maybe you only have 29 actual full-time employees. In that case, you would never trigger an A penalty, even though you're subject to the penalties, but the A penalty would never be triggered because $2,000 times your total full-time employee count minus the first 30, well, you don't have as many full-time employees as the first 30, so you'd be off the hook. On the other hand, of course, you could, if say you already know you have 200 full-time employees, you don't even need to do the full-time equivalent calculation. But anyway, you only offer coverage to actual full-time employees, and it's based on 30 or more hours of service per week. An hour of service is each hour for which the employee is paid or entitled to payment, which is the same rule as exists in pension on the pension side. Part-time, seasonable, and variable rate employees would be considered full-time if they average 30 hours of service per week. And there are two methods for computing this, and we're going to talk briefly about the methods in this program. We're not going to talk in detail about the methods, but we'll hit the methods in the December program. There's a monthly method. An employee is considered full-time if credited with 130 or more hours of service for a particular month, and then the employee must be, to avoid the mandate, the employee must be offered coverage for those months in which the employee is paid for at least 130 hours, or works 130 hours, or is paid for the 130 hours. Now, the monthly method requires that you be psychic. You have to, if you're using the monthly method, you have to know at the beginning of the month who's going to have 130. And for many employers, their workforce is stable, and they know who's going to have 130 for that month. You can stop providing coverage if the employee terminates, so you don't have to be psychic as to whether the employee is going to terminate in a given month. But it's pretty clear. I mean, my employer can be pretty comfortable that I'm going to be working full-time for a given month, and that's true for many employers and most employees of those employers. And then those who are part-time, you know that they're going to be part-time, and it's all based on a regular schedule. So many employers will be able to work the monthly method just fine. They'll need to pay attention in case there's a deviation, but it will generally work. Some employers, however, have part-time employees who are all over the map. They may very well have 30 or more hours of service for certain periods and be below it during others. And so there's a look-back method that the IRS allows you to use, and under that method, you'll have a measurement period where you determine whether the individuals average 30 or more hours per week during 30 or more hours per week during that period. Then there will be a stability period in which you offer the coverage to the employees who meet the full-time threshold during the measurement period. And then there will be a possibility of an administrative period in between times if you need time to sign them up, and there is some room for an orientation period at the beginning of an employee's service. And we'll deal with those concepts in a lot more detail in the December program. If an employee is rehired, terminates and is rehired within 13 weeks, then they continue to have their hours measured just as they were before. Employees hired after 13 weeks can be treated as new employees. Now, there is room for a waiting period. Employers have always had waiting periods at the beginning of their health coverage. I mean, not all employers. Some employers offer coverage at day one, but most employers probably offer some kind of a waiting period. For purposes of the mandate, the penalty, you're allowed to have a full 3-month period plus whatever stub month if the employee was hired in the middle of the month before you have to offer coverage, and you won't have either the A penalty or the B penalty if you start coverage no later than the first day of the 4th month following date of hire. But there's another problem, and that's that another part of the Affordable Care Act caps the waiting period that a plan can have at 90 days, and that's an actual 90 days. That rule requires coverage at the end of the 90-day period. So on the 91st day, and there's no, there's no, if it falls on Sunday, then the next Monday is good enough. It's the actual 91st day, and you can provide it the previous Friday if you want. This is an important rule in addition to the rules for the mandate, because the penalty for violating the General Affordable Care Act rules about what plans can do is $100 per day per affected individual. And that can be far worse than the mandate. So in setting waiting periods, you want to be careful to make sure that there's no actual waiting period of more than 90 days. And if you want all your coverage to start on the first day of a month, then you need to use a 60-day waiting period rather than 90 days. This 90-day waiting period limitation, that's effective for everybody for plan years beginning on or after January 1st, 2015. That rule doesn't delay till 2016. This rule applies to both grandfathered and non-grandfathered group health plans. There can be other eligibility rules. Now, there are reporting requirements. We're not going to talk about these in detail today. We'll cover those in more detail in the next program. And there's some additional slides that we're not going to discuss right now, but they're available for your perusal, and we can reach them next month. People have been allowed to ask questions. I don't see the questions. Maybe my people can tell me how I get the questions. Okay, I'm told that there aren't any questions.
How
does a person ask a question? I don't know. I don't know how you ask questions, but I'll try to get somebody to tell us that.
How does the Act define full-time employee?
Oh, I'm not ready for the questions yet. Okay, you have questions? All right. We'll try to deal with the questions. I apologize that we don't have that. The technology worked out perfectly on that. We thought we did. There is an item that I want to mention that is relevant to small businesses. A lot of employers, this is on slide 26, a lot of employers had been paying individual premiums. A lot of smaller employers particularly would, instead of having a group plan, would pay individual premiums, reimburse the employee for individual premiums. That is not allowed anymore, and that ceased to be allowed by June 30th of 2015. For employers with 50 or more employees, it wasn't allowed since the Affordable Care Act, although the guidance wasn't clear until recently. But for the smaller employees, it was not going to be penalized as long as it stopped by June 30th. And this, I run into this all the time. A lot of small businesses were doing this. And it's really important for small businesses to know that they can't do that anymore. It would still be tax excludable if the employer did it, and you don't solve anything by treating it as taxable income. It isn't taxable income, but it is a violation of the Affordable Care Act, and the penalty will be $100 per day per affected individual. All right, I see some questions popping up. Let's see if I can answer a few of them. Question, is it offering coverage to 70% in 2016 and not 95% of your full-time employees? No, the 70% rule was for 2015. Once you hit the 2016 effective date, the test is 95%. Can you give an example of how the rate of pay safe harbor works using actual figures? Well, I'm not sure how much of that I can design in my head, but if an employee is paid $20,000 per year plus tips, or plus overtime or plus bonuses, then 9.5% of the $20,000 per year would be the rate of pay, and you break that down by payroll period or by month or however it's convenient to collect the premium from the individual, and that would be how the rate of pay safe harbor worked. For that individual, if you're using W-2, you could include the tips and the overtime, but the rate of pay safe harbor does not include that type of actual numbers. Let's see, there's a question, how does the Act define full-time employee? Well, we've talked briefly about it. It's a 30-hour, it's averaging 30 hours a week or more. There's the hourly method, there's the monthly method to measure it, there's the look-back method to measure it. The look-back method is quite complicated, and we will talk in more detail about how to make those computations in the next program. Are employees of a smaller employer, fewer than 50 employees, covered by the Affordable Care Act if acquired by an ALE in the year the acquisition occurs, starting from the date of the closing of the acquisition? That's a good question. I believe there are some special rules for dealing with acquisitions. In general, your 50-employee threshold, though, is tested based on your prior calendar year. So you should, I mean, the company acquired may also be, you may acquire a company that was already over 50 employees, and that may have that company may have to comply during the year of the acquisition. It won't get an exemption if it was over 50 employees, but the acquiring employer, if the acquiring employer was below 50 and it's that acquisition that puts it over 50, the compliance should be able to be just by the acquired company without full control group compliance for that year of acquisition. Okay, somebody says they asked a question, but I don't see what the question is. Okay, those are the. Okay, I'm told that there aren't any more questions. I'd like to thank you for attending, and I hope you can sign in for next month's program.